Hi guys, welcome to Self Free Wealth. So I'm going to say something that might hurt your ego, but I'm still going to take that risk because even if you disagree with me, I want you to think about it. So many of you do SIPs regardless of the valuation of the fund or the market, right? Why? Because you have been fed this idea that you can't time the market and that the funds will always give you good returns. So let me, give you an example here. Everyone buys tomatoes and onions. So they usually cost 40 rupees, 50 rupees per kg. Uh, but when you see them shooting up to 200, 250, uh, and you know that the price is not sustainable, and if you had a choice, uh, would you have bought them at 250? Remember, I'm saying if you had a choice, don't come in the comment section and say onions and tomatoes are in need of everyone. So if you had a choice that, I know that tomatoes are going to come back to, 50, 100, I'm going to buy then. I'm sure everyone would have done that. At least most of you would have done that. So common sense is, don't overpay, not because you can't afford it, but because it's not worth it, right? So you wait till the price makes sense again. Now, if that is the case with, tomatoes or onions, where does that common sense go when it comes to mutual funds or stocks? Uh, I see primarily four reasons, what investors tell themselves. You can fool the world, you can't fool yourself, right? So, the first reason that they tell is, I can't time the market. And that is true. You can't. But, guess what? Your fund managers also can't time the market. If they could, they would have beaten the index or the benchmark, at all times. But they haven't. And please understand, I'm not saying that you should stop investing. In fact, you should look at increasing the investment if you can. What I'm saying is look at the asset class, look at the fund, wherever you're investing, make sure that the valuation makes sense to you. That's reason number one. Second reason that investors give themselves is, I don't have time. I work, I can't do that. But then, ask yourself, don't you know the returns of the funds? And how do you know that? Because you keep checking that. Now, it takes only 5 minutes, right, to check the valuation of the fund that you are invested in and the underlying stocks in it. For some, it could take 30 minutes, maybe more. But then that much time, I'm sure everyone can take out and take a call, right? You don't have to necessarily take out the money or, stop investing in that fund. But I always feel as long as you're informed, you will make the right decisions. So that's second thing. And the third thing that investors, tell themselves is, my fund manager will handle it. And yes, it's their job. And most of them are good at it, right? So it's their bread and butter. But here is the issue that they also face. When you keep pouring in money, when the market valuation is high, it is difficult for them to find stocks at right valuation. So basically what is happening here is you're obligating them to buy stocks at a price which they wouldn't have if they had a choice. Because we keep pouring money, so what they do is they keep investing your money and they have to do that. So because they keep doing that, and hence, in the long run, when the fund has bought stocks at higher valuation, the fund underperforms. Okay. And the fourth reason is, what investors tell themselves is that I'll make good returns anyway. And that is true. If you stay invested through, crest and troughs, which means lows and highs, it is going to average out and probably will make good returns. But if you have an opportunity to make better returns, why not do that? Go back to that, tomato example. You have to buy something which is overpriced and it is going to come down because high valuations cannot sustain for long periods of time. And you know, most of you watching this, are smart. I should say all of you are smart. Um, but then why do we do this? It is because of the narrative that has been pushed by media and the mutual fund companies, uh, that you should always invest, because if you continue investing, their AUM grows, and that's the business, right? So, but because of that narrative that is being pushed so hard, it dilutes our ability to think critically. So let me give you two examples to support my reasoning. Warren Buffett sat on $350 billion cash. Parag Parikh held nearly 25% of their AUM in cash or cash equivalents. Why? Because they have skin in the game, and probably they want to protect investors too. So I'm sure this is something to really think about. I have already made a video on the strategy I follow. I am going to link that in the comments. Thanks for watching. Stay sharp, stay intentional. This is Hustle Free Wealth, and please consult your financial advisor before you make any kind of decision. This is just for educational purpose. Thank you. Have a blessed day.